Morning, market chameleons, and soon to appear Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Great show last night, buddy.
Thank you.
Very informative webinar. Let's start with the disclaimer.
Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, contact your broker. That's what they're there for, to provide you with guidance, help answer your questions. There's the disclaimer.
Great. What are you seeing this morning?
Let's get started. Just share my screen real quick. Take a look at the pre-market movers, and then I think we'll move on, maybe take a look at some stocks from fundamental perspective, as we build these fundamental features and ways to analyze stocks from different angles and perspective. I think I'll just touch upon that every day. Then we'll take a look at any questions you have along the way. Of course, I'm going to try to answer those first. If we don't have questions, we could take a look at some earnings and some bullish bearish ideas. So with that, let's get started with the pre-market report. So these are stocks trading in pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to use this filter to take a look at what's going on in the higher market cap stocks, so 20 billion market cap or higher. That will filter this report. So we get about 18 stocks that made the percentage gainers list, 92 on the percentage decliners list. So from that perspective, looks like a bearish bias at the open. I'm taking a look. The only one, PBR, maybe sticks out. It's trading 2.6 million shares in a pre-market, up 6.2%. I do see some.
Is that oil and gas?
It's oil and gas.
Yeah.
So up, and that's what in Brazil. That's a Brazilian company. Is that correct?
I also see BP's up.
British Petroleum, that's up 2% in a pre-market, 388,000 shares trading. So those are really the, EOG, I think that's also oil and gas up 1.8%. So at least like we see CVX. So that oil and gas sector seems like money's flowing into there in the morning in the pre-market hours. But in general, lots of stocks down today. I'm going to take a look at a couple of reported earnings yesterday. So I'm just going to hit on this earnings, see what popped up. I see Occidental Petroleum reported earnings, that's down 3%. Home Depot, we talked about that yesterday, down 2.5%. So let's take a closer look at Home Depot. And then I'm going to move on to some of the fundamentals. Unless you have any questions along the way, Will, let me know.
Yeah, I will.
I'm going to click on Home Depot here just to bring up what's going on in pre-market hours. So we see closed at $275.85, trading in a pre-market hours, 269.09. That's down 2.5%. Since it's earnings, we can come down here. We see reported earnings. I'm going to take a look at its earnings history here. So this tab looks at the behavior of Home Depot around earnings. I'm going to come down here and we'll see this is day of earnings in the last 12 quarters, what it tended to do. So we see at the opening gap, 64% of the time open lower, 36% of the time open higher for an average loss of 0.8%. On average, the move up or down. So you can see it could gap up, it could gap down. The magnitude of the move in either direction, if we convert all these to positive moves and average them out, is 1.9%. with a high of 3.4 and a low of 0.2. So it's higher than the average today, down 2.5%. That's more than the historical average, but within the range, right? So it's within its high-low range. This is what it tended to do after the open. From the opening price to the high of the day, average move was up 1.2%. From the opening price to the low of the day, average move was down 1.7%. From the open to the close, on average, it lost 0.3% and it's about 50-50 half the time. 55% of the time it was lower, 45% higher from the opening to the close drift. And it looks like, coming out the following days, it tended to weaken a little bit. So you can see here next day, a couple days after. Let me take let's just go to Home Depot really quickly. Since they announced earnings, I'm going to go to the earnings and see what actually happened here. So this is what happened as far as their earnings report. They reported today before the market opened. They reported earnings of $2.74. Analyst consensus was $2.62. So we see it beat there by 12 cents. It reported actual earnings of $32.3 billion versus analyst estimates of $30.7 billion. So it beat on the revenue. Like, and I try to emphasize this every day. Remember, this number doesn't tell the whole story. So we see the stock's down 2.5%. Beat, stock down 2.5%. Same thing like it did last time. Beat, stock was down 2.5%. You could see that happened already 3 earnings in a row. So why is that happening? That's because a couple things. The stock price does not reflect the expectation of analysts, right? So whatever you have analysts, their consensus, it could be 5 analysts, 10 analysts, it could be 20 analysts, right? They have an average of 20 analysts, but the stock price reflects the expectations of the millions of traders, right? That's the expectations built into the stock price. So that's important to understand, that stock price reflects stakeholders' expectations, traders, investors, not the expectations of an analyst. So that's one thing. The other thing is that this number doesn't tell you the whole story. It's just a metric, right? We reported earnings, but traders are trading based on future expectations. What is the management saying about the future of their business, right? What is the management guiding us, or how did we even come to this number, right? It could be by 12 cents, but if that number is good, but it's not based on profits from their normal everyday operation business, but because they sold some building that they had for 20 years and it's a one-time sale and they got this great earnings, well, the traders who put that into their models are going to take that into account. So you just have to get used to understanding that. Okay, so let's just take a look at the press release really quickly, because really what we're looking for is, well, how did they get to this number and what are they saying going forward? Because that's probably why it's down, all right? And I'm going to click on this press release. They released earnings yesterday. I'm just going to scan it really quickly to give you an idea. So look, dividend up 10%. That's good news. You're increasing your dividend, so you must have some confidence that your cash flow going forward is going to cover that. It looks to me like that this quarter, as we saw, was good. Up 25%, increased 24.5% on sales. So that's good. So let's just scroll really quickly down. What are they expecting going forward? Fiscal 2020, and to me, it looks like this is where it's coming from. They are not giving us guidance, given the uncertainty related to COVID. They're not giving us guidance. So that's not good. If they usually do give you guidance and forecasts, if the company itself doesn't have clarity anymore, that's a little bit risky. Like, what's going on? Why is the company not providing guidance? If they're used to doing it, so they must not be that confident in something that they're seeing. What else do we see right here? They're saying, look, they're not providing guidance, but they kind of did. And here's what they said: the demand environment during, if we use the demand environment during the back half of fiscal 2020, so if we're just using the most recent data, right? And that persists through fiscal 2021, that would imply flat to slightly positive comparable sales growth. So basically they're saying if we just use our most recent data, we think we're not going to grow. We're going to be flat to maybe slightly positive. So that's where it's coming from, right? Because if we're building into Home Depot, and all of a sudden they're saying, hey, we think we might be flat, then boom, that's going to affect your stock. Does that make sense to everybody? Because it's important just to understand the dynamics. Why is the stock reacting the way it's reacting? And that's going to be a basis going forward. You'll understand, you want to be able to trade or invest, you need to understand those dynamics. Let me know, Will, if people have any questions about that.
I will.
I'm just going to take a look really quickly just to see where the options were priced. So here we see this is the bar over here. This is yesterday's bar, and that's the straddle. It was pricing a move in either direction. So remember, we start at 0. If you buy call, buy put, you're looking at a move in either direction to cover the premium of both the call and the put, right? So in either direction, that's what this bar is. I'm hovering over it. So today they reported before the market opens. So far, we're down 2.7%. We haven't opened yet. That's our most recent indicator. The straddle was implying a move of 3.4%. So if it sits here, that will be with, a more muted move than the straddle was implying. So that's really quickly Home Depot. Let me take a look at, if there are no questions on Home Depot, let me just take a look at what's another metric here. So we see that Home Depot, these are its gross margins, net margins, operating margins, 14%. So if we take a look at their growth rates, it had pretty good growth rates, right? Look, revenue last year grew 13%. If we take the 3-year average, revenue grew 8% on average per year. Same thing in the last 5 years, 8%, which is better than the S&P 500. 5%, 4% last year. S&P 500 lost 1%. So if they're saying that growth, if you're pricing this into your model, an 8% growth rate, and they're indicating to you, hey, we're kind of seeing we might be flat here, that's going to weigh in on your model, right, going forward. So just wanted to point that out. Let's take a look at Tesla. And let me know if you have questions while coming up. So we see here Tesla at this point, look, the 52-week high 900. We're at 677 right now in the pre-market. Yesterday it closed at $714.50. I'm just going to take a look at quickly what we think fair value would be for Tesla if we used historical multiples. So here we see, based on historical multiples, we think it's around $557.83. If we're here, it's about a 28% premium, which is actually not even, I'm seeing premiums way more than this in other stocks. But just to take a look how we got there, if we take a look at the PE ratio, doesn't really have a price to earnings and nothing stable there because didn't really have a lot of earnings in the last 3 years. I think they just started to become profitable, so we can't use that as a measurement. But let's take a look at the price to sales. So the price to sales is saying, if we take Tesla's market cap divided by their revenue, total sales, not profits, total sales, this is the 3-year average. So if we use that as our basis, that's the implied value of the stock. I'm going to skip this PE because there's no earnings. Let's take a look at how that compares to SPY, the rest of the market. So we see here, if we use today's Tesla's price to sales versus SPY, it's trading at a 776% premium. This is the 3-year average premium. So if we get back to that, that's the implied value. If we take the average of those, that's where we are. So we can see here, we're kind of elevated. So let's just take a look though at Tesla's fundamentals and, maybe just get some more insight in there. So here's Tesla's profit margin. Gross margins are 21%. And that, if we just compare that to the rest of the S&P 500 of 32%, we see, at least from that perspective, they're not, for every dollar in sale they have of a car, and if we subtract what it cost them to produce that car, they have 21 cents left, right? That's 21 cents left to go towards other expenses, marketing, administrative, all the other expenses. So you can see, like, it's not very high gross margins, especially like we could compare that to something like SPY. They're much lower. Of course, if you're going forward, if you think that they have what we call price elasticity, right, where they could raise if they could raise their prices, right, and not see a drop off in growth, then their gross margins could go up, or they cut their costs and keep the prices the same, then their gross margins will go up. But you could see here, at least this is the 5-year historicals. So far, it's been like right in that range, 20, between as low as 17%, high as 23%. But so far, that's not really grown. Operating margins. So this is where they really did well relative to the last 5 years, right? So they actually converted their operating profits to 6% of revenue. And that's pretty good considering they only have 21% margin, 6% operating margins. I think that's pretty good, but look, versus SPY, 12%, they don't have as much cushion basically, right? If you got 6% versus 12%, not as much cushion there. Again, right now it's being priced on super growth, but we're just taking a look at it from the perspective of just the margins. Net margins, 2% compared to SPY, 8%. So in general, not as much cushion after they sell how much money they have left over. Let's take a look at its growth rates here. So so we see here the growth rate in revenue looks good, right? Last year they grew 28%, but here's the thing. You see that their growth rate, the rate of growth, to me, at least to me, looks like it's declining, because if we take a 5-year look at it, on average, it went up 51%. If we take a 3-year look at it, on average, it went up 39%. Last year, 28%. So it is increasing, and that's a pretty fast growth rate. It's just the rate of growth to me looks like it's starting to decline a little bit, but that way exceeds, anything in the S&P 500, right? 5%, 4%. But this is where they really did well, I think, is in the operating income, where they just were losing money, and then all of a sudden, boom, they're in the profits. So that got people excited. So that's just really quickly, if we're just taking a look at Tesla from the perspective of their profit margins and their growth rates, comparing it to, the S&P 500, you get a perspective of what you're getting into. And they could improve their margins. Look, they could come up with, they're very innovative, so they could come up with, I don't know, are they coming up with other products, that are higher margin, like something with batteries? Or
Well, supposedly the battery technology is incredible. This ARK Investment, Kathleen Woods, constantly talks about their AI, their ability that they'll be able to, they've driven more miles and know more about the roads and the infrastructure of driving, in their data sets than any other car manufacturer. And she feels like that is super valuable. So,
right. So that's where people are putting the value maybe in. They think that it's the proprietary technology, right, that they're having, that they have, or some other, but that's what you have to start thinking about. How much of that, how much premium do you want to put into that outlook? And I'll give you just as an example, let's just compare it to another one like say, Microsoft. So I'll show you here Microsoft, 68% gross margins. In other words, every dollar of revenue that they sell, they got 68 cents left over to pay for other stuff, right? So that's a big margin compared to Tesla's 21. They have a lot of cushion there, for research development, making mistakes. That's a much bigger cushion and way bigger than the S&P 500, SPY 32%. Operating margin, 37%. That compares to SPY's 13%. So that's huge difference right there. That look how they're converting, right? 68% gross margins, operating margins 37%, net margins 31%. And it's kind of like, they're improving it, right? Look at that. They're improving it year to year. They're improving their gross margins. They're improving their net margins. So that, at least to me on the surface, looks, I'm getting more cushion, right? There's more cushion for every dollar in sale. What about their growth rates? So here are the growth rates in Microsoft. Not as big as Tesla, right? So we're not growing as fast, but 14% growth last year versus S&P minus 1%. I think that's pretty good. 17% 3-year average, 12% 5-year average. So here, compared to the S&P, still doing much better, right? S&P 5-year average 5%, 4% in the 5-year. Let's compare that to the QQQ. Let's come back. Let's do the NASDAQ 100. So look, profit margins versus QQQ, 68% versus 46%. So QQQ higher profit margins, 46%. Operating margins still better, 37% versus QQQ 18%. Net margins 31% versus QQQ 15%. So twice, this is more than 2 times better than the QQQ. Growth rates. So here are the growth rates here. QQQ last year grew 11%, Microsoft 14%. Beat them on the 1 year, beat them on the 3-year average, slightly beat them on a 5-year average. If we look at net income growth, did pretty good in the last 3 years, still beating them on the 1 year. 1 year, 16% net income growth, QQQ 6%. Microsoft's operating income, 22% versus QQQ 4%. So here you get a lot more cushion. You're still getting growth, right? And you've already got earnings here, So here we see PE 34.9, right? So we've still got it like a high. Let me just see really quickly fair value Microsoft. So Microsoft's actually, right at fair value, like a little bit of a discount. This market price fair value, that's if we revert to historical PEs. Is this PE 34.9? Is it reasonable? Look, this is its 3-year average, 39.8. If we take a look at their growth rate, let me just come to it. The rule of thumb is, you kind of, if you have a P of 34.9, your expectation is the rule of thumb, right? If you're doing a PEG ratio, that you're going to be growing at an annual rate of 34.9 at least. And it does look reasonable to me sorry, that's not the growth rate. So if we use this growth rate, 3-year average, it's kind of in line, right? These might be a little bit high, but that just taking a look at it from comparing Tesla and Microsoft. And by the way, Microsoft also has proprietary technology. They're in every computer. They also have lots of data in there that could be monetized as well, right? What are they doing now? Are they cloud gaming? They're in a bunch of different areas as well, not to mention on every desktop computer. So that's really quickly just showing you Tesla, Microsoft. We could look at like Google, or we could start looking at, if you don't have any questions, well, I'll just go to some options.
Well, we did have, you mentioned that there were a lot of stocks at you saw premiums greater than what was shown in Tesla. Is there a way to screen for that, or is that just when you were doing your analysis, looking at different stocks?
No, I was just kind of like just looking at the like here's price to, so this is like, look at Tesla's price to sales. So this is just based off their revenue. You're going 26 times its sales. I mean, like look at, let's see, General Motors. General Motors is not even 1 time sale. It's 0.6. So just giving you like a comparison. Look, General Motors gross margins, 11%. Net margins are low. Operating margins are low, but they're profitable, right? So they are generating income here. But you could see here, they're converting about half their gross margins to operating margins. You're looking at 5%. They're not growing as fast. I mean, they have actually negative growth here. So operating income, they did grow last year. But you could see here, in car manufacturers, historically, here's Ford. They're not even 1 time sales. You're talking about a fraction, 0.4%. Look at the book value. Ford is 1.5 times its book value. Let me see, General Motors, 1.7 times its book value, right? So that's its breakup value, 1.7. I don't know what Tesla is. You're 33. So you're building in a lot of growth in there, and it might have, it's a great car. This has nothing to do with Tesla car or management. It's just we're comparing its valuation to what we're seeing it execute so far, right? And how far away it's stretched. So even if it does well, right, how much can the stock go up? The earnings still have to catch up to its valuation. So you might be sitting here, even if the stock sits here, it still has to execute that growth. That's where I was looking at. But I mean, this is a pretty Roku's in high growth. Let's take a look at that. So price to sales, Roku 32. They're not generating earnings yet, but they've got higher gross margins. Right. They're still not profitable even on their operating margin side. Here's their growth rate. So they're growing their revenues very fast, 58% last year. And that's accelerating, So their 3-year average is above their 5-year average, and last year it was above 3-year average and 5-year average. So you got like an acceleration of which, when you see that kind of growth rate, people will tolerate negative margins, right? As long as they're not that high, because the assumption is you're gaining customers, you're making more sales, then you're reinvesting that, and then you start becoming efficient once you've got that critical mass to convert it. But they've got a big cushion. Look, 45% gross margins, to convert that into profits seems reasonable, because you're already keeping, out of every dollar sale, you're keeping 45 cents towards other expenses.
Very
Hopefully
cool.
this is starting to make sense.
We only have 2 minutes. I don't know if you can get to this question. If not, we can get to it tomorrow. Patel is asking, and he'd like to do it with DPZ, which earnings are coming up in Domino's Pizza. He's asking, is there a way to filter first quarter earnings seasonality for individual stocks?
First quarter earnings seasonality. I don't think there's a way to filter that. I mean, I think I know it. I think that this is what the question is. Let's say DPZ. So if we go to DPZ stock patterns, right? So we see here, this is in the last 12 quarters, and we see heading into earnings, it had historical run-ups, right? And this is what it did day after earnings. But I think his question is the following. if instead of looking at it from the perspective of last 12 quarters, what if, what if we just filtered out fourth quarter, right?
Yeah, that's
That's the question.
Yeah. Well, he's asking for.
So he's looking at, huh?
I think he's asking for first quarter, but
or first quarter, but per quarter. Like if you just wanted to look at how did it behave around the first quarter, instead of, I don't have a filter, but I'll write that.
you know what?
I will make note of it because I've had that request come up, multiple times. So I'll make a note of that for like a future enhancement, but we don't have that right now.
Great. Well, it's 9:30. Awesome job. Every day is super educational, D. Thanks so much, buddy.
All right. Thanks, everyone. Stay safe. Have a great trading